This week was a difficult one for Wall Street as the Dow dropped 1,700 points today and early trading halted for a bit as the stock market entered a bear market after a long bull run. Carloee McGrath sat down with Matthew Farkas, the vice president and head of fixed income for Germain Investments in Springfield, and Sylvia, Callan, portfolio manager at their Northampton office, which operates under the name of Gage Wiley, to learn more. And full disclosure, Germain Investments is a financial supporter of New England Public Media.
Well, today we're starting to look at how will this impact the global economy, not just, back in the beginning it was China and how this was going to impact its economy. Now that it's hitting Europe in intensity, in the United States, now it's having ramifications for the whole world and our own economy. So we really need to start seeing some numbers on, especially for corporate profits. A lot of companies have started to guide down, and so that's what really moves stock market prices. And until we can really get a clear picture on corporate profits, we're still going to have some of this volatility. And as we were talking earlier, that this is still in the early stages here in the United States, and there is a lot of business activity that's getting canceled, postponed. So until there's more clarity on the corporate side, we are still in a state of flux. And we are hopeful that the stock market is maybe getting a little ahead of itself and that things won't be that bad. But as companies start to announce earnings and earnings guidance, we might see that things actually have swung too far to the other side, and maybe that there might be an opportunity here for investors to start looking at some opportunities, but it's still a little bit early on that. So we do need some clarity on the corporate side.
So the Dow this morning went down 1,700 points. Obviously a big difference from when we spoke about a month ago, where there were record highs, 29,000 and more for the Dow. That's scary for a lot of people who especially can't help themselves by checking, their portfolios.
Yeah, the market's been very volatile over the last couple of weeks, and anytime there's this much volatility, it's really natural for someone's anxiety to increase, to be worried about their investments. That's perfectly natural. What we try to tell our investors is that we at Germain, and I know at Gage Wiley as well, build portfolios for the long run. So typically they're well diversified, have different asset classes in there, have exposure to stocks, yes, in most cases, but also have safer assets like high quality bonds. And when you're highly diversified like that, the bond exposure does help cushion some of the equity downturn that we've seen. It is hard to, when markets are swinging like this, to stay the course. But typically that is the best thing to do. Making an emotional decision with your financial life is typically not the best thing to do and can be detrimental to your long-term well-being.
Okay, and trading was halted for a time today, and if you go back to Monday, another similar drop where trading was halted as well, but part of that was due to oil. Can you explain that for us, Sylvia?
Yes, oil was a difficult one, actually. It really came out of left field. It was kind of an insult to injury. I won't get into the politics of it, but by adding supply at a time when there's really little demand, it just kind of jolted investors. And so, yes, that was a difficult day. However, I think it kind of woke people up, especially governments worldwide. It's really the central banks. Just to give some people some backgrounds, they're the ones who have typically been the ones to support the market by having lower interest rates, stimulus, and I think that over time they've kind of run out of the tools in their toolkit. And what we need now are governments to come in with some fiscal stimulus. And when that oil shock hit, or the news, and oil prices fell, it's time for some government stimulus. It's fiscal stimulus time, not just from our government, but from Germany, from China. I hope they're hearing this because we really do need that. There's a lot of folks in the Midwest. We are now oil exporters, so there are jobs at risk there. Yes, it's going to be great for the consumer. Yes, it's going to be great for the airline industry, But if there's
no one's flying, really.
right, or if if the unemployment rate goes up a little bit because of the Midwest folks who are in the shale industry, oil is a big part of our economy now. So I think for all intents and purposes, it was definitely something that really raised my eyebrows, and I'm really looking for some fiscal stimulus here. So that, I think, coupled with already the issues with coronavirus, I believe led to that halting of the trade. That really was something that people were not expecting.
Do you think that other investors agree and are looking for some sort of federal stimulus? Are they satisfied with what President Trump said last night, or do you think that the market is wanting more?
As we're talking about, the market's dealing with two external shocks, and so I think it's appropriate for the government to step in. There's two main levers that the government can pull. One is through the monetary authorities, through our central banks. They can lower interest rates. They actually stepped in a week or two ago to lower interest rates, expected to continue to lower interest rates. Lower interest rates help stimulate borrowing, help stimulate economic activity. The second thing is we also are hoping for some sort of a stimulus package coming from D.C., and that can be new spending, new government programs, which would be help offset any weakness that we may see in the economy due to the coronavirus. Or it could be form of tax cuts that puts more money back in the hands of consumers, which they can spend and help generate economic activity.
And you were talking a little bit also about interest rates that the Fed just cut and could do so again. That is good for people who are looking to buy a house or to refinance. And refinance, those numbers are up, correct?
Yeah, I think the markets are pricing in a pretty good chance of a slowdown, perhaps a recession, depending on how long the virus is with us, perhaps a pretty good recession. So it is time to take a look at your own personal finances and really make sure that you have things in order. Hopefully you have a little bit of a savings, to lean on during a tough time. Not everybody does, but there are things that you can do looking at your own personal situation to reduce your monthly expenses. And one of those is refinancing. Mortgage rates are right at all-time lows. So it makes sense for most people, if they can refinance, to look at their situation and refinance, and that is a way that they could save a little bit money on their monthly payment. Other things that people can do is look at their finances. Are there monthly subscriptions that they may not need? Gym memberships they're not using, Netflix they're not watching, things like that. Every little bit helps in kind of getting your situation right if we are entering a recession. And
explain a little bit about the bear market. So we've now entered the bear market, and that's when you drop 20%, right, from the peak high, and that's what we're in. And we were at a historic run.
Yes, that is where we're in, and bear markets followed by recessions tend to be worse. So if we are going into that period, I would suggest that people really heed this often cited advice, which is look at your portfolios. Is it allocated according to your risk tolerance? As Matt mentioned earlier, bonds can help provide protection. Yes, they're not yielding much. Yes, it's probably not a lot of income, but there's more value to them than just that. And if you're uncomfortable, just a slight adjustment might make you feel better. And having that cash on hand for, let's say you take distributions, having 6 months ahead so that you're not, maybe selling if the market does fall a little bit. However, because the market has been such a swift bear market, it's one of the fastest. It could be that it has already priced in a lot of the bad news, especially if we don't go into a recession. If we can fend this off, which is why I think the fiscal stimulus is so important, I really hope that they do come through, because our economy was doing really well. Yeah. I think let's not forget about that.
Yeah. Historically low unemployment.
It was absolutely rocking. And so the shift was so quick. I think we can still do something that can help if we just come together and we work together. We have a bipartisan policy. It's very possible. So to be able to not say, okay, this is what's going to happen or this is what's going to happen, but be prepared for the worst, but hope for the best.